I'm looking at the Dow Jones behind the camera there, and it's down another 600 points today. I feel this is not a new movie. I've seen it at least twice before. I've seen and I've experienced the .com bubble. I've seen and I've experienced the subprime crisis, the real estate bubble. And in both cases, there were plenty of people standing up, raising their hands and saying, this is wrong. This shouldn't be. Companies shouldn't be having this kind of valuations, making no profits. That was the .com bubble. Secretaries shouldn't be becoming millionaires. The .com bubble. And we were warned, but nobody wants to believe. And then something happens as a catalyst to make all the bad things come to the surface, and the market collapses. The second time was the subprime crisis, and that's even fresher in my mind, that there were books being written that said this is going to collapse, but nobody wanted to believe them. Get the movie The Big Short. If you haven't seen that, or if you weren't around for the subprime crisis, get the movie The Big Short and realize that this was not a surprise. And the catalyst was the failure of Lehman Brothers. And once Lehman Brothers failed, it forced all the bad things to come to surface and be reconciled with, and caused the collapse of 2008, 2009, and the recovery through the following 10 years. This is nothing new. What usually happens is the first domino falls, and many times the first domino is not really the cause of the problem. I believe we've got a similar situation going on right now. I have identified what I believe are 4 elements that are wrong with our society. And the video I did last week with Warren Buffett and Charlie Munger, they spoke directly to this. The liquidity, the amount of money that is coming into the market through debt and through the government printing money and pushing it into the market and driving the stock market up. Number 2, free money. Interest rates are down so low that it is actually encouraging corporations, individuals, students to take debt that they have no ability to repay, and thus creating a very precarious situation for our economy. Number 3, the underfunding of all the financial instruments that are tied to the retirement of the baby boomers. And here I'm speaking of state and federal pension funds, Medicare, and Social Security. They're all underfunded, and the underlying states and federal governments are going to have to pay for these, and they have no means for paying for them other than increasing the debt and printing more money. And then FANG. I call it FANG because it's the concentration of our investments in basically 5 companies. The Facebooks, the Googles, the Amazons, FANG. Because so many people are now investing in index funds, they buy the S&P index. Well, you're getting a disproportionate share of Apple, Google, Amazon, and Facebook because they are the high-price stocks in there, and so you get a disproportionate share of them. And that's part of what's pushing them so high. So once any one of those 4 come to the surface and create a problem, the market collapses. Well, as in the case of the Lehman Brothers failure, we have a different domino this time, and that is the virus. The virus has now brought to focus that if China disrupts the supply chain And the easiest way to understand this is the automobile industry. If there are parts being made or should have been made in China that now can't be acquired because China's economy has shut down, that shuts down the auto industry. So what happens there? Well, then the auto industry starts laying people off. Now what starts happening? People are getting laid off, so they don't go out to eat as much. They don't go on vacation. So consumption comes down. You then have, because the auto industry isn't making as many automobiles because they can't get their parts, some of the supply companies have to lay people off. And now some of the supply companies who have borrowed money in the subprime market, in the junk bond market, can't make payments on their junk bond debt. So those junk bonds default, and we now start the collapse coming in. So it's a domino effect. Now what happens is, because they can't pay for their subprime debt, they can't pay their payments, they file bankruptcy. More people get laid off. And that's the domino effect. Please watch The Big Short. Now, what does the government do? We already know what they're going to do. They've already pre-announced it. They're going to lower interest rates again. So what does that do? Well, they say, okay, if we lower the interest rates, maybe those junk bond people can make payments. No, junk bond interest rates will not probably come down. So now they go to negative interest rates. What's that? That's in essence the government saying, and banks saying, we'll pay you to take out debt so as to stimulate the economy. Again, we're creating not free money, but money that we pay you to take. Is that reasonable? Does it make sense? Is it sustainable? No. I want you to look at a chart, and it's a chart of the Dow Jones Industrials. It dates back to 1915. Do you see anything that looks a little peculiar about this chart? How it relatively looks like it's running on a flat line and then starts to take off somewhere in the 90s. It's actually not a flat chart. It's actually growing at a natural pace. But then in 1990, we see a surge. We see the market from 1990 to 1999 go up by 500%. That's the Dow Jones average. Goes up by 500%. And that is fueled in large part by the .com, the internet introduction, and we get the .com bubble. Then we see a correction in 2002 of a 48% correction. So almost 50% of the value of the companies in the Dow Jones goes away. So after we recover from the .com crisis, or we're through it, from 2002 to 2007, the Dow goes up 95%. In 2009, we have the start of the subprime crisis, the failure of Lehman Brothers, and we see a downturn in the market of 58%. It takes about 2 years for this to occur. And then we see from 2009, we recover up to 2020, and the market increases in value by over 300%. And that's where we are today. Now, over on the side, I want you to recognize that as this market goes up and down, it's being fed by the National Treasury. Our national debt in 1990 was $4 trillion. In a matter of 10 years, it goes up another 14 trillion to 18 trillion. And then from 2009 to 2020, it goes up to 23 trillion. It's just, is it happenstance that as the federal government is going further and further and further in debt, that the stock market takes off. Is this an artificial support of the stock market? We see for the 200 years prior to 1990, it took us 200 years to accumulate $4 trillion worth of debt. And then it took us, 20 years to put on another $20 trillion worth of debt. Folks, I'm sorry, but I think this is just, I think it's an accident waiting to happen. So what does our government say they're going to do? Well, they've already given indications that they're probably going to throw us some lifeboats. And that lifeboats will be lower interest rates, maybe even negative interest rates. What is a negative interest rate? Well, it's basically you go down to the bank and say, I want to borrow $100,000. And they say, okay, we'll pay you $1,000 to borrow $100,000. So in other words, they're paying you to borrow money. That's what negative interest rates are. It's another lifeboat. And then, I'm sure, they're going to print more money, another lifeboat. Well, I think what the market is doing, and what it's done over the last several days, is they've seen this coronavirus affecting the world economy. They aren't stupid. They know that the economy is teetering on a very precarious balance. And as the Fed and the Treasury throw us these lifeboats, they know the ship is sinking. And so the market is reacting accordingly. You've got to recognize that when you go into the stock market, you're going into a casino. And like I said, if you've ever been to Las Vegas and you've been to some of these casinos, they're elaborate, they're beautiful, they're works of art. And it takes a lot of money to support them. So you got to go into that casino knowing that the majority of people that leave have to lose in order to support the structure. Well, when you go to the stock market, those people are using artificial intelligence to do their trading. They've got the smartest people in the world, smarter than the people in Silicon Valley, because their stakes are so damn much higher. They know what's going to happen, but they'll let you win as long as you make them winners. Well, the game is over, and they're ready to reset the tables. And they're going to reset it at your expense. Now, I've shared with you, I got out of this about a month ago. I held on to Zillow because I knew Zillow was going to have a wonderful quarter. And then as soon as they did, I sold it. And then I took everything to 10-year treasuries. And today I'm making money. I'm up 3% on my 10-year treasuries today. You got to get out of the casino when the owner decides it's time to clear the tables of money. And that's where we're at. How far is this going to go down? History tells me it'll be 50%. So that would say the Dow will go from, 20,000 to 10,000. That sounds pretty radical to me, but I don't know. I saw something on TV today, on Halftime Report or something like that as you age, you should move your money to fixed investments in a percentage equal to your age. Well, I'm 75, so they're telling me that I should be 75% in treasuries. Well, actually, I'm 100% in treasuries. Oh, I would say 95. I got a little bit of cash to go on vacations and to do some things that my wife and I want to do. But this is, it's time to find the exits. It's time to wake up to the game you're playing in and recognize you're in over your head. But you can win at this game if you pay attention. If you pay attention to the dealer, and the dealer is clearing the table right now. Okay, is it a bubble? I think the bubble has popped. Think of it as a balloon. It's starting to deflate. Okay, if you find this video of value, give me a thumbs up. Subscribe. I'm in a race. Against time. I'm trying to get to 1 million subscribers, and I'm 75 years old. I don't have a lot of time to get it done, so I need your help. I need you to get your grandmother, your nephews, your nieces, anybody and everybody you know to subscribe and learn from this. If it's helping you, it can help them. And that's what this world needs to be. We need to play fair. And we need to share. So, I'm going to the social media marketing world. My wife's a little bit upset. She says there's somewhere between 6,000 to 8,000 people there. Why would you expose yourself to that? Go find a mask. I can't find any masks, but I'm taking plenty of hand wipes. So, I hope to be back next week, and let's pay attention.